It's just not smart to do to be swinging long call options when VIX is above 20. Definitely not when VIX is in the 30 area. When VIX is in the 30 area, you do not want to be taking new long call options. Now, if you were in one previously, say you were in a call option when VIX was at 15 and prices moved in your favor, in this case, you're probably happy because the IV has also probably pushed the price of your contract up. Okay. Now, I specifically said long call options. When VIX is above 20 to 25, it's a very good time to sell options. So selling puts, selling strangles, selling iron condors, right? These actually perform very well up until VIX gets to about 35. Over 35, fucking nothing does well, right? Like over 35 on VIX, very little does well. You're talking about potentially gold, potentially oil, or bonds, right? Like those are about the only things, or if you play volatility itself. Okay. So for the VIX markers, we have two of them. One, when VIX is above 15, you need some kind of defense in your portfolio. I recommend 1% of your account, 30-day VIX call options, and you roll those every week. Okay. And then there is a profit taking schedule there that we can talk about in another video. Two, when VIX gets above 20, you need to really, I'll just say it, when VIX gets above 20, no new long call options. If you're going to trade, you need to be trading shares or you need to be selling options. Selling options up in this area can be very profitable, right? So let's go to the fourth flag. The fourth flag, I'm going to look at RSP here. What is it for the Qs? I think it's like QQQE. Yeah, the equal weighted Qs. So let's look at RSP because this is what I typically use. So RSP is the equal weighted S&P 500. And this is important to look at. So up until here, we were looking at the Qs through February, right? So let's look at QQQ through February, right? So up until beginning of March, basically all year, right? Like it hasn't really done anything. It's been below the 20-day, the 20 days going down. We're making lower lows and lower highs. However, if you look at RSP, up until literally since the Iran war started, what was RSP doing? It was moving up. So this means that on average, the average stock in the market may have actually been trending up. It just meant that you could say, okay, maybe money is just flowing away from the heavily concentrated, heavily weighted tech stocks. But there were lots of things that were moving up. We looked at some of them, Coca-Cola, Walmart, Kroger, right? There are names that were moving up. So it is possible to make money. And this is why I have been saying you can still trade in this environment. You just need to know where you're looking. You need to size appropriately. You need to take profits very quickly, but it is possible to still make money. When RSP starts breaking down, so when RSP is below its 20-day moving average and the average is going down, when RSP is making lower lows and lower highs, this means that now on average, no, the market is in distribution. If you're ready to see the full detailed breakdown of this videos and gain access to the same system that allowed me to retire at 35 while working a full-time job as a management consultant, then you need to be in the Construct. Inside the Construct, you'll get access to over 100 hours of educational content, daily live streams, and my personal trading framework. Click the link in the video below to start your free trial in the Construct today. The market is moving down. On average, the stock market is going down. So what's your adjustment here? Your adjustment here would be, let's take this in a vacuum, put everything else aside. Let's say we're just looking at this condition. When this is the case, you have to be very selective with what you're playing. By that, you need to understand why the market is dropping. If you can't clearly point to or enumerate why the market is moving down, you have no business trading. And I don't mean like you saw some talking head on the news or some influencer. No, you need to really understand why. Is the Fed raising interest rates? Is there a war? Is there an election? Is there a banking run? Is there a banking crisis going on? You need to really understand what sectors are pulling the market down, and you need to understand what sectors are moving up. What sectors are moving up? We'll look at them right now. XLU, utilities. Over the same time frame, look, utilities consolidated and then ran. And then what have they done in the last couple of weeks? consolidated, and then on Friday, they popped, they ran. What's an example here? Edison consolidated, they do the electricity for New York City. Look, here's where you can go. So again, and we have an entry here a couple of days ago. So this is what I mean. When RSP is moving down, you need to know for two things. One, what is driving the market down? Because that can help point you to what to avoid. Okay, what things to stay away from, and that gives you some idea of where to look. And then two, you better damn know where to look. So we're talking about utilities. What else can we look at? Fertilizer. So here's NTR, here's CF, and wheat moving up. Okay, so when RSP is moving down, you better damn know where to look. Now let's take all of this in totality. Let's say we have all of these things. RSP is moving down, VIX is over 25, in our case it's up around 28. We're getting lower highs and lower lows on the Qs, and prices below the 20-day moving average on the Qs, and the 20-day moving average is going down. We have all four of those things. For most traders, you're done, okay? You do not take any trades. You just manage what you have only if it's profitable. Only if it's profitable. If you are currently in a trade and it is red, but it has not yet hit your stop loss, fuck it. Cut it, get out. Time to go home. Take your ball, go home. We'll come back next weekend. Like, we're not playing games no more, okay? This period right now that we're in, March 15th, all of these conditions exist. This is for the big boys and girls, okay? This is the period of the market that separates great traders from good traders and puts unprofitable traders out of business. If you're playing right now, if you're fucking around, taking setups right now, and you don't for sure know you have an edge, you have a strategy, you have clear defined rules, you know how to manage your risk, you know how to defend your portfolio, you have some income coming in off the side to support yourself, you're gonna hurt, okay? It is a dangerous time to be in the market. That's why I'm putting this video out. Right now is not a safe time if you're new and you don't know what you're doing. What you can do, study charts. Find somebody who is profitable. Learn from them. How are they navigating this market? How did they find where to go and where to trade? Ask them, how did you know how to take this trade? How did you know to avoid this trade? How are you sizing? What are you doing differently? Okay, now is a great time to learn, all right? Because we have all four of these conditions. Last piece here. Actually, you know what? Let's do this. The last piece here, the 200-day moving average, okay? Price is fighting it. Futures opened and actually opened below. Price opened below the 200-day moving average. It's trying to get above it here on futures. Let's look at NQ futures. That would be analogous to the Qs. Same thing. On Friday, on the Qs, price actually closed below the 200-day moving average. Had a pretty big gap down today when futures opened, and now it's trying to get above it. The 200-day moving average is our next signal. For the 200-day moving average, let's just consider that in a vacuum, put everything else aside for now. When price closes below the 200-day moving average on the Qs, you're done. You're done. You're done. Everything, any long trades you have, you're done. Okay, this is what I would teach you. You're done. You're out. You're done playing. Time to go home. Even if it's profitable, even if you have a profitable trade, you're done. You take all your stuff and you go home. You go to cash. Okay? If you're an experienced trader, you know how to navigate this environment. You've got some stuff that's profitable. You want to let it run. Keep running. Okay, cool. Like, you want to hedge your portfolio, or let's say you know how to manage covered calls and stuff like that. Okay, that's fine. For everyone else, price closes below the 200-day moving average, you're done. You're gone. Okay? The average size of a red day below the 200-day moving average is 2.5 times larger than the average size of a red day when price is above it. Okay? So if the average red day on the Qs is 1% when price is above the 200-day moving average, the average size of a red day when price is below it is 2.5%. Okay? The average size of a green day when price is below the 200-day moving average is half of the green day size when price is above it. Okay? This is why the 200-day moving average is so powerful. Market sentiment completely fucking changes below the 200-day moving average. Why? This is the institutional buy and sell button. When price crosses this, institutions either buy or sell. Okay? They either buy or sell. If you cross below it, you want to be getting out. Okay. You want to be getting out. Full disclosure here, there will be times where price crisscrosses back and forth. It will not be long. Okay. Those periods will not exist for very long. If those periods exist where price, let's see if we can find one. If those periods exist, like right here in the beginning of 2023, right? Price fought the average for a couple of days and then it made up its mind. They only exist for a small period of time. Okay. And again, we're talking about a window here. We're not talking about all in or all out. We're speaking as traders here. When price closes above, okay, now the window opens for you to potentially take entries. All right. When price closes back below it, okay, we need to get out. All right. Yes, there will be some back and forth here, but these periods do not exist for very long. They are meant to save you. Okay. They are meant to save you from these huge drawdowns. Okay. I'm not going to get into the performance of how to use the 200-day moving average itself as a trading strategy. Those strategies exist in the room. If you're watching this in the room, if you're watching this on YouTube, I've got videos on YouTube around the performance of using the 200-day moving average. It beats buy and hold by far, hands down. Okay. The 200-day moving average is your trigger. When price closes below that, you get the fuck out of everything. That is currently the environment we're in. Price is potentially going to move below the 200-day moving average for sure. So one question that could come up, and I just showed it to you on purpose. On the futures market, price did close below the 200-day on the NASDAQ on Friday. It did close below it. So this would have been a judgment call because it was below on NQ, but it was not below on ES. It was technically not below on the Qs and technically not below on SPX, which is the actual S&P 500 index. Technically not. But here's the thing, one more day of price below on NQ and everything else would be below. So yes, technically we exist in this kind of Schrodinger's paradigm now where like price is both above and below. Here's the thing. If we're looking at three potential things for the S&P 500. We have SPX, which is the actual index. We have ES, which is futures that mostly track the index. And we have SPY, which is an ETF that is meant to track the index, but it doesn't track it 100%. If any one of them loses the 200-day, use it as a signal, okay? Because I can tell you there is no market condition that is going to exist where SPY closes below the 200-day moving average and ES and SPX don't. And it's this fantastic trading you find this fucking life-changing trade. That's not going to exist. If SPY loses the 200-day, if SPX loses the 200-day, or if ES, but not all three of them do, guess what? It's a shitty market. Like, it's not a good market to be in. You're probably losing money anyway. Okay. Same thing for NQ, NDX, and the Qs. If price closes below the 200-day on one of those three, it's a bad market. Okay. I'm not going to get into, because it's not the scope of this video, how to short the market, but that is the adjustment. And so that's what we need to talk about now. If we have all five of these conditions, okay, and the reason I mentioned the 200-day last is because if the 200-day if price is below the 200-day, odds are those other four, RSP, VIX, lower lows, lower highs, and the 20-day, they exist as well. When price closes below the 200-day, here's the trade. Short the market. I'm not going to talk about it in this video because shorting is difficult. Okay, shorting the market is hard. Taking puts on the market is hard. The market does not want to go down. Okay, the current administration does not want the market to go down. Market participants do not want the market to go down. Okay, it doesn't want to go down until it does. And when it does, it goes down quick. Okay, so that is the trade here. That's not the scope of this video. We'll put something out very soon on how to short the market because that could potentially come into play here. We have a nice level here. We look at it on the Qs. Look at all these bounces on that. What is that? 591, 592 area. 1, 2, 3, 4. And then if we go back 5, 6, 7, 8, and look at what's right there, the 200-day moving average. So we have a lot of confluence right here. If price does lose this area, it's looking like a really juicy short, Okay. When all of these conditions exist, or if one of these conditions to exist, I gave you some ways to adjust your trading, adjust your sizing, adjust your profit taking, adjust how you're taking stops. Okay, so you can survive longer and be a more profitable trader when these conditions exist. This is a difficult market to trade in. Okay, these like sideways, just like back and forth, like slow bleed out markets, these are the worst ones to exist in because some things go up and some things go down. There's volatility. This lie and say one thing one day and then they lie and say another thing the next day. And the market just believes all the lies because the market is a fucking teenage girl or a teenage boy, right? And the market is incredibly naive. The market hasn't learned to develop a truth detector yet or a lie detector and sniff out when people are blatantly lying, okay? So it's a difficult market right now. It's the middle of March 2026. It's hard to make money, but there is money to be made and we are making money in the room, okay? So if this is the kind of stuff that you're struggling with, if this is the kind of thing you need help with, right? Tag the video, send something to me. Hopefully this helps. If you have any questions, again, send them to me, tag the video, throw it up in the room. Okay. Hopefully this is helpful for you guys and we'll see you in the next one. Hey guys, look, this clip is just a glimpse of the kind of research and education and training content we do in the Construct every single day. To see the full version of this training and unlock over 100 hours of trading and investing educational content, join us inside the Construct. I'll show you exactly how I leveraged these tools and techniques and my strategy I used to retire at 35 while working a full-time 9-to-5 job, working over 60 hours. From daily live streams to proprietary research, it's all waiting there for you, including a supportive community of like-minded traders and investors just like yourself. Use the link in this video to start your free trial in Construct today.